Hey folks, it's Rob Flux here with another Sunday session. And today we're going to be talking all about branding your projects. Now, we all start small and with delusions of grandeur into growing up into bigger developers. But when we go and speak to our accountants and our solicitors, they're telling us every single time that we want to be setting up what is called a special purpose vehicle in order to go into each project and shut it down at the end. That is for both asset protection and tax minimization. But if we're going to do that, how the heck do we keep our brand name alive? How do we keep the branding, the consistency of who we are, so we can actually go out and do bigger and better projects as people pick up on the great work that we're actually doing? Now, in order to, talk about how do we actually do that, I've got an expert in the field. We've got Peter Lee from GLG Legal. He's going to talk to us all about branding and brand protection. So, Peter, firstly, welcome to the table.
Thank you for having me. It's a pleasure to talk to other people interested in property.
No worries, mate. So firstly, give us a little bit of an insight about yourself and GLG Legal, and I guess why you guys are the experts in this particular one, why should we be listening to you today?
Well, I've been doing property for a very long time. I was practicing back in the 80s and witnessed the boom times there. In fact, I had clients who their objective was to move the decimal point. That's effectively increased the value tenfold, and they did. We probably don't see that sort of thing anymore, but I've got the bug at that stage and I've been involved with property ever since. I've obtained a accredited specialist status with the Queensland Law Society. There are not many of us. And I've been running a property law firm for many years. GLG Legal is another separate property firm that I've known of for some time. And we joined forces last year to become GLG Legal here in the Brisbane CBD. So, while we are a Brisbane-based firm, we act for developer clients all over, and we're happy to extend our expertise interstate.
And the reason for that being, obviously, that a lot of the things that we're talking about here, they're national laws, and so I guess geography doesn't really hold you back. Through the powers of Zoom and things like that, you can run meetings all the way around the country.
That's correct. So we find that most of the laws we deal with now are national laws, so that would include taxation, trademarks, intellectual property, most of the laws that we deal with. There are some state-based laws, particularly in the area of property. So titling and titled property come through the states, and stamp duty come through the states. And they're two big issues with respect to property development. But even though we have different laws in each state, they're largely the same. They just have a different name and different section references. And we're used to that. We deal with that across the board. But the bulk of what we're talking about today, such as branding, asset protection, how to protect your assets, is largely all national law. So it applies Australia-wide.
Very good. Now, I touched on it in the intro, mate. If I go and talk to my accountant, he's going to give me some great structuring advice around my tax minimization. And if I go talk to my solicitor, he's going to give me some great advice with regards to asset protection. Those two aren't always in alignment and quite often very contradictory. And then we want to layer this branding thing on top, over the top. So maybe just for, I guess, the newbies out there, why don't we just cover a little bit of groundwork about, I guess, what are the kinds of structures that we might want to go into a development into, and what specifically is a special purpose vehicle that we're told to set these things up in?
Okay, you've touched on an important point, and that's that the client will speak to their accountant, and we very much encourage them to do so. And also, we touch on the same areas to some extent, as in the structuring options and the various tax implications of them. But from my personal experience, I don't force my views upon the clients, because I'm not the one that'll sign the tax return next year or the year after. That's the accountant. So we have to be of the same mind when it comes to what structures are going to suit the client and what the tax consequences of that are. So we actually work with the accountants, not independently of them, for virtually all of our commercial clients. Now, when it comes to owning property, it depends what you're intending to do with it. As a general rule, if you're looking to buy property and hold it as an investment, you want it in a vehicle where you can get the capital gains tax benefits. That's usually a trust or individual ownership. That's not what we're talking about here today, and Rob's got plenty of previous guests who have spoken about that at length. What we're looking at today is a company that's going to carry on a business or develop some property. Now, that is carrying on a business for tax purposes. The issue of capital gains tax doesn't arise. So we're going to have our company carrying on the business. Now, if we have a nice brand name, we've come up with a terrific name that aids us in selling, and we do a lot of marketing and spend a lot of money in promoting that brand name, we don't want to see that die at the end of the project, particularly if we've done a good job and we get a good reputation and there's a queue of people wanting to buy a similar product. We want that brand name and that reputation to continue going forward. But as Rob has said, our accountant has told us that at the end of the project, we want that company wound up. We're going to pay out all the profits, wind it up, so that there are no further claims that the tax office didn't realise or somebody else didn't realise, and we don't get a surprise after the event. So how then do we wind up the company but preserve that goodwill? And the answer, funnily enough, comes from franchising practice and licensing of goodwill. So typically with a franchise, you'll have a holding company or an entity which owns the brand name, the trademarks, the intellectual property, and they will grant a license to the franchisee to operate their business under that brand name with their business model to run a profitable business for them. And at the end of that business, the brand name always remains with the holding company and then goes back to the holding company. And if the sub-operation doesn't go as the holding company would like, or if they're beginning to give some bad name to their reputation, they have powers to deal with that under the license to, if in a worst case, call back the brand name and the goodwill so that it doesn't get damaged any further. So that introduces the concept of the dual entity. So we have the holding entity, which could be a company or it could be a trust, and I'll talk about that later. And it grants a license to the development entity, which for this particular project, we're buying 2 acres of land and splitting it into 40 house lots. They get the right to use the company name, Broadacre Developments or whatever it might be, or Broadacre Townhouses, whatever that might be. And if they get a good reputation, then when that project's finished, there's a fair bit of value that flows back to that brand name. And it's over here, it's separate from the trading entity. So anyone that wants to sue the trading entity sues the trading entity, but it stops there. They can't get to the holding company, which has the asset value, such as the goodwill and the brand name. So that's the simplest form of structuring.
And it's so thank you for that. It's worthwhile, I guess, going into why that development entity and a lot of the people give guidance on that being a special purpose vehicle to be shut down. So I guess the name special purpose vehicle, as it implies, is for the special purpose of doing that one project. So you start it up, you run your project, you close it down, you get out of Dodge. And that's, as you touched on before, that's for, close out your tax liabilities, but it's also for some asset protection side of things, because inherently there's some ongoing warranty obligations they're going to sit with, some of those, if you're doing constructions and things like that. We want those, warranty obligations to be honoured, but ideally we want those to be honoured by the builder and or the homeowner's warranty insurance and not by us directly.
Yes.
So where humanly possible, we want to get out of town and let them go straight to the builder or straight to the homeowner's warranty insurance. That's
correct. So as Rob has touched upon, all homeowners, when they buy a home, get the benefit of the Home Builders Protection Insurance. In Queensland, it's the QBCC. There are similar bodies through every state which provide up to 6 years guarantee of the quality of the home. When the builder gets development approval, he has to pay an insurance premium for that project, and that insurance is retained. And if the building requires work, and if there's no developer or builder to fix it, then the insurance from the QBCC will be used to fix that work. Now, the important middle point is this, that the development company is entering into a contract with its buyers, and so it has contractual liability with those buyers. And if those buyers, after 3 or 4 years, find a defect that they think the developer shouldn't have allowed to happen, they may have the right to sue the developer under contract. They may also sue the developer on a separate cause of action in negligence, i.e. you should have known that septic system would fail in 2 years, and therefore I'm suing you. And now the developer may well have a right of indemnity from the builder, so they join the builder to that litigation and say, well, if I'm liable to the buyer, you're liable to me. But you imagine the legal costs involved in that will be hundreds of thousands of dollars. And at the end of the day, the developer really hasn't had much to do with it. The builders built it in accordance with development approval, approved by council, and sold it to the buyer. Is it wise to leave the company lingering for 6 or 7 years so it can get dragged into such litigation? Or should the company step out, let the buyer have claims possibly against the builder and certainly against the QBCC, And if the valid claim is valid, QBCC will force the builder to rectify the work. So the buyer's getting their relief. They're using the insurance that was initially paid for. So it's probably not wise to leave the development company around to just be another person that could be sued because it has money. And it gets dragged into litigation, which it really can't contribute anything to. And at the end of the day, we're looking for indemnities from the builders. So yes, I agree with that.
Yeah, so just putting all of that in lay speak, just for, I guess, the people that don't understand some of the jargon, effectively, the developer has sold it to the ultimate owner. That ultimate owner has a claim directly against the developer because the developer promised it was going to be of a certain quality.
Correct.
I guess the developer has a counterclaim against the builder because the builder promised to build it to that quality.
That's correct.
So the developer's sitting in the middle of two law cases.
That's right. He's just the middleman.
Whereas the builder actually was the one who actually built it.
That's correct.
So if we can get out of that process and shut down that process, then I guess the homeowner's warranty insurance allows or has a mechanism actually built in place. Now, those homeowners warranties exist all the way around the country. You touched on QBCC, but there's the Office of Fair Trading in New South Wales. There's the Victorian Building Authority in Victoria and a whole bunch of others as you proceed around the country. So all of them have very, very similar schemes. So the whole, intent of the special purpose vehicle is to start it up and shut it down and I guess allow the process to work as a process.
Yes.
There are some other benefits that come from it from a tax perspective, being that once the project, because developments tend to get lumpy cash, once you've actually recorded your first lot of lumpy cash, the ATO then says, we want what is called PAYG, pay as you go tax every single quarter, forever and a day, whether that project is going to ever exist again. So that's one challenge. And the second challenge is you've made some money, you've got some assets in place. If you kept that same entity alive and then did the next project and then the next project, you might get 3 or 4 that are successful. And then one then has this cascading effect and cleans up all of the assets that you've had in one go. So for a whole variety of reasons, setting up that entity and shutting it down is, I guess, the general, feedback.
Yes.
Not advice, folks, not from me at least, maybe from Peter. But that's generally the feedback that we get from both our solicitors and also from our accounting team.
Yes, there's an unfortunate reality in Australia. It's a little bit like the tall poppy syndrome, but it's people are willing to sue an entity with money. If the company has no money, they won't sue it, or if it's not there, they won't sue it. But if they see it with a pile of money, they'll think, I want some of that. If I just make a claim, they'll pay me money to go away. It's very unfortunate, but that's the way it is. So having a company that's made a couple of $100,000 on a property development, it's not wise to leave the money in there. Now, we will touch on the various different entities, but using a company is good because the tax rate's only 25%. But that means 75% of the money, the profit, remains in that company. It can sit there and you don't pay any tax on it, but it's like a lure to the claimants. It's like bees to a honeypot. When people know there's money in there, they'll make a go for it. And you're better off winding it up, taking the money out, paying it out as franked dividends, repaying directors' loans and everything else, and then start with another one on the next venture. Possibly the only exception to that would be if the company has run a loss, you'll have carry forward losses, and you might want to use those on the next project. But obviously, if you've got carry forward losses, there's not going to be a pool of cash there to worry about. So we can use that vehicle again and carry forward those losses. Just be careful with carry forward losses. There are a lot of anti-avoidance provisions that make them rather fragile. So if you have a company with losses in it, don't change anything. Don't change the shareholding. Don't change your activity. Don't wind the company up. Please talk to your accountant first, and we'll tell you how to make use of those losses.
And ideally, don't get into a project that's going to lose money. That's probably
unfortunately not always perfect, and it's going to happen occasionally. And if it does, let's make the most of a bad situation.
Okay, just to close out this special purpose vehicle side of things, the SPV, I guess, name can exist for many, many types of entities, and each time you go into a project, it's going to be unique for every single circumstance. So are you going to sell all of them? Are you going to keep some of them? Are you going to sell some, keep some? Are you going to keep all of them? Are you doing that with a joint venture party? All the different permutations that sit around that. So just touch on some of the different entities that you could be doing this in,
Yes.
and why people need to actually get advice on which is the right one for that one project.
Yes, there are a variety of entities that we can use for a particular development project, and which one we're going to use will depend on the circumstances of the individuals participating in the project and what they're putting in. The most obvious one is a company, a proprietary limited company. Now, I've said previously that all of this will be on income account, not on capital gains account for the development company. So a company is an okay vehicle, but it's one of many. Another one, for example, could be a unit trust. If for some reason the investors would prefer to use a unit trust, they can. Now, the difference with a trust is that a trust, although it's a separate legal entity, it's really not for tax purposes. It's more of a conduit. So if the venture earns $100,000, it must pay out $100,000 out through the trust, whether that's to unit holders or discretionary beneficiaries. If it doesn't pay that money out, the trust will be taxed at the top rate applicable to tax. So yes, you can leave the money there, but you're going to get taxed at basically 50%, and very few people want that. So the money must flow through the trust to somewhere else. The corollary of that is that there's very rarely any money sitting in a trust. So if you use a trust as a development project, you can't leave the money sitting there. So there's no point in not winding it up when you're finished. It's not a situation where you're going to have accumulated capital. Discretionary trusts can be useful. They can be very useful, but they're only useful if there's one family running the operation and going to benefit from the operation. They also are transparent for capital gains tax purposes, and all of the cash flow can flow through the trust. The trust will pay zero tax provided it distributes all the income to those beneficiaries. The problem with these is they are, as the name implies, discretionary, and the trustee gets the right to distribute all of the capital to any one of the beneficiaries to the exclusion of all others. So obviously that's not very helpful if you're in business with a business partner who expects to receive half the profits. In that situation, you'd use a unit trust, which has a similar result. For a family situation, you can use a discretionary trust. And another one of the benefits there is towards the end of the financial year, you might see one of your family members with a very low income, and you could distribute, say, $50,000 of income to them at a very low tax rate. That's the discretion coming to help again. And there's nothing wrong with having a unit trust, and the units in the trust are held by 50% of the units are held by your family trust, and 50% of the units are held by your partner's family trust. Then you receive the income out of the unit trust, and you can distribute what you wish, how you wish, out of your discretionary trust, out of your half. So that's the trust structures. They're very helpful, very useful for capital gains tax, possibly not so useful for a development activity, which is clearly going to be assessed on business income principles. Another one is partnership. I find this not uncommon, where people have got mature business activities or mature trusts which have all the money or the capital they're going to use for the venture, and they want to go into a partnership arrangement. And we can do that. Just as you and I, as persons, can have a partnership, two trusts can have a partnership. We have a partnership deed, a partnership agreement. Hopefully, both of these trusts have companies as trustees, so they have limited liability. And if not, we may be able to interpose a company to achieve that in the form of an incorporated joint venture. So partnerships are quite common, where and also that often saves us having to transfer assets and incur stamp duty and capital gains tax. So that's another reason why partnerships and also joint ventures are similar. Now, the difference between a joint venture and a partnership is the Partnership Act defines a partnership as carrying on business with a view to a profit, and for the partners to get a share of that profit. So the definition there is a share of the profit. Joint ventures are even treated separately under the tax law, provided they're not in truth a partnership. So what the tax office will say there is, you might call it a joint venture, but we think it's a partnership because you just put in half the amount of money each, you bought a piece of land, you developed it, and you made a profit. That's just a partnership. However, if you can say, well, partner A owned the land and he put it in, partner B owned all the earth moving equipment, he used all of that to subdivide the land, and then we kept half the blocks each, that's clearly a joint venture. And you can get the benefit of joint venture tax situations and the different laws that apply. Just be very careful with joint ventures. A lot of people think, it's the top end of property development, and to a large extent it is, but there is not a lot of law with respect to joint ventures. With a partnership, there's hundreds of years of law that will protect you. With joint ventures, there's virtually none. So for joint ventures, it depends entirely on the wording of the joint venture document, and you need to have a very experienced lawyer and your accountant involved in drafting the joint venture, set out clearly who's putting in what, who will be doing what, how we value these things. It's all very well to say we'll get half the profit each, but what is profit? How do you define that when people are putting in different things? So there's a great deal of care and attention needs to be given to those. They can be tremendously helpful and valuable and save a lot in the way of stamp duty and taxes, but great care needs to be done in using them. And of course, self-managed super funds can be involved in property. I've got a number of concerns with that. Self-managed super funds under the Superannuation Industry Supervision Act are not allowed to carry on a business. And as I said previously, property development is usually a business. So bear in mind that if you're using a super fund, how do you get around that problem? Secondly, super funds have to have an investment strategy, a written investment strategy for the super fund. So you need to make sure you fit within that parameters. The other thing is about the liquidity of super funds. If you've got $2 million in a super fund, it's a bit hard to justify to the Superannuation Commissioner that spending all of that money to buy a piece of land and possibly do a subdivision is a balanced, risk-assessed investment for the super fund. By the other hand, if you've got 10 million in the super fund and you use 2 million for that purpose, that's much more likely to be okay. So those issues are all relevant.
So all of that was just covering the baseline. What is a special purpose vehicle? And I guess go and seek your own personal advice, both from your accountant and your solicitor, as to what the development structure is, because there's pros and cons for each of those entities. What we're talking about here today, though, is the branding. So how do we do one special purpose vehicle for one project, and then we roll into project number 2, which is another special purpose vehicle, might be a completely different structure, but we want to keep the same branding across each of them so that, as we touched on before, we get the goodwill that came from doing that excellent job day number 1, and we keep that rolling and rolling and rolling, and the momentum of that makes projects number 3, 4, 5 more successful, because people can see that we've been doing projects for eons at that point. So you touched on it before, I guess a holding entity of some form of description that's going to, I guess, hold, I guess, the branding. But why don't we first talk about what is branding? What are the things that we need to consider from a branding? Is it just the name, or are there other things that we need to protect?
So all of these things that you're referring to come under the definition of intellectual property. We call it intellectual property, and it'll often cover a brand name, a trademark, a logo. They're the 3 physical things you're likely to see, and it'll often extend to copyright. There are different acts that deal with these things. A lot of people assume I've got a registered business name, so I'm protected, or my company name is registered at ASIC, so I'm protected. That's just not true. There are a number of issues with registering a business name, and I would recommend that you do so as part of protecting the brand, but it's not sufficient on its own. So what other things might we look at? The most important is going to be trademarks and trademark registration. And a lot of companies have more than one trademark. So you can actually trademark a series of words, you can trademark a sequence of colors, you can trademark a logo, you can trademark a smell. You might remember that old sound that modems used to make when you logged on to the internet back in the 90s. That's actually trademarked, that sound. So you can trademark just about anything. Now, there are specialists who deal with trademarks attorneys, and Rob and I discussed that previously, but that's the cornerstone. The registration of a trademark is a cornerstone of protecting your intellectual property. And the trademark can be just the name with a capital C or whatever it is. It used to be rather difficult to do that, but if you have some degree of stylization in it at all, then you can trademark that. And that's a much stronger protection than business name registration. Now, as Rob mentioned, if we've done a project and it's called Century Development, with all due respect to Century, I'm sure there are some out there, but this is just an example. And we've done a wonderful project. It's 20 stories high. We've sold off 80 apartments, and the feedback is fantastic. The agents are raving about it. The newspapers reported how great it is. All of our buyers are reporting how wonderful it is. We've got fantastic brand name recognition there, and we don't want that just to die with the project. When we wind up that development company, we don't want that name and goodwill to be gone. We've spent millions in the marketing for that. We want to use it again. And so there's nothing wrong with having that brand name, not in the development entities, which we're going to wind up, but in a separate holding vehicle called a holding company. It is very common in most businesses, most big brands that you see around the place, brand names that you see, are not owned by the entity you trade with. They're owned by a holding company. I won't give any names because I'm not sure exactly, but most of the listed companies in Australia use holding companies to hold their brand names. I won't go into it, but often those holding companies are in other countries, often tax havens, so they can spread the tax overseas, but that's a bit beyond the scope of our paper today. But they have a separate entity. And so when the development finishes and we wind up the company, even if it's successful, we've got to wind the company up. We don't want to see that goodwill die with that company. We want it to go on to the next project, which might be 200 metres down the road. And we've already got a great deal of marketing and a great deal of anticipation. And that's how we protect it in that holding company. Now, the holding company, maybe not for the first one, but certainly for subsequent ones where it does have a great deal of value in that brand name and the recognition and the marketing it's previously done, would grant a license to a development company and say, I will license you to use this logo, this brand name in your marketing and so forth. And that leads us into a franchise or franchising arrangements are a form of licensing. Now, it's not appropriate to go into detail into franchising arrangements here today, but it does give us a very good guide on how to use that model, because that is the model that's used in franchising. It's called business format franchising. And the licensing extends, and I know from experience there that it's not just the brand name we're concerned with. We're actually concerned with quality and giving a quality image to the public and preserving the quality image of that brand name. It's no good for me to get paid $10,000 from one of my franchisees or one of my licensees who is trashing my brand name, doing dreadful work and getting bad reputations, and I'm seeing things on social media which are terrible. I want to deal with that. So my license agreement will, firstly, it will set out in the first place what they can use my brand for, where they can use it, what circumstances they can use it. Secondly, it will set out standards of performance and presentation. And thirdly, it will give me the right to pull that brand back if they breach those conditions so that I can preserve the branding. And that's the way you can develop value in that brand. Mm-hmm.
Yeah, because I mean, goodwill is can also be bad will. So if we don't protect, I guess, those minimum standards and make sure that it's appropriate. Now, in a lot of instances, it's us wearing one hat and then us wearing another hat.
Exactly.
There are other times where we might be lending that into a special purpose vehicle that might, for example, be a joint venture with a builder, or might be a joint venture with a money partner. Or so it's not always me wearing both hats. Sometimes it's me wearing one hat and then me and somebody else trying to share a hat. So I guess those minimum standards and the build quality, the timelines, the brand reputation, all those sorts of things. What are some of the other things that we want to touch on in that protective mechanism?
Well, yes, you're entirely correct. And again, we learned some lessons from franchising in that you can only do a certain number of projects yourself before you hit what I call one of the ceilings. And that can be the amount of personal exertion you can put in, the amount of capital you need to put in, the amount of time you have to allocate to those projects. So you've got 3 projects on the go, you're going to be extremely busy. But if you're doing this licensing system, as Rob has mentioned, you might have a joint venture with a builder on project A. So you don't need to be all that physically involved with that. You're just managing your brand, and you don't want that builder. Yes, I've agreed that on this occasion, he can get the benefit of it for this project because we're in it together. But when he's finished, he's not going to be able to use that license, that name anymore. He'll go away and do other things, or we may do other things in the future and grant other licenses. But the value of the license comes back to me. And the other wonderful thing about this is we spent $2 million on the first project advertising this and building our reputation. Now we're going to spend another $2 million on the second project advertising and developing our brand name even further. And the brand name's getting bigger and bigger and bigger. All the while, these development companies are probably paying us a license fee to use that brand name. So we're sitting back having other people running marketing teams, running marketing campaigns for the sale of their project, and all the while our brand name's getting more and more value added to it. And that's why we need to protect it, particularly after the first 2 or 3 projects. But we also need to protect it. There's no degree of legal wording is going to protect us from bad reputation and bad press. And we just need to be able to act very quickly if someone is not doing the right thing with the brand name. And that's where the licensing documentation comes into it. It's very important for us.
Yeah, and one of the advantages at the moment, we're all thinking that it's me going to do each project every single time, but you touched on it appropriately. At some point, I'm going to run out of resources.
Yes.
And so if I take it to the very, very extreme, I could actually license that to a complete third party, not be me at all, may be able to actually generate some revenue from that process. And so long as the brand standards are maintained, then I still get the reputational benefit that actually comes from that. Now, a really great example of that, or bad example, depending upon your political perspective, I know that Donald Trump used to do a lot of licensing agreements. He would not do any developments himself, but he would get royalties that came from just using his brand name on a whole bunch of things. And that's taking the extreme view of the world.
Well, yes. Yeah, so licensing is very good, and there's a lot we can learn from franchising to the extent you want to go into it. I'm not suggesting that we have big, long franchise control documents, but we can snip and paste the bits, the really good bits out of those franchises to protect your brand name. And at the end of the day, look, the figures are staggering. If you actually look into the valuations that have been put on a lot of these brands of those listed public companies that I mentioned, the value of the brands is massive, and it can often exceed the value of the other business activities. However, having said that, you're starting off in business, you're going to have your brand name. And again, I won't mention any names, but Rob and I discussed some previously. There are very well-known developers in the medium-sized development market, the large-sized development market, the unit development market, and they have their own reputation for quality bills, and there are people queuing up to buy their product because the name is attached to it. So it's all very well to have that, but you really will have to be very proactive in protecting that brand name. It would be naive to think I can sit back and license to 10 different people and get 100,000 off each one and make $1 million. Well, you can, but you'll only do it once, because one of those 10 or two of those 10 aren't going to do the job properly, and your reputation can be trashed. And it only takes one out of those 10 to be bad, and the reputation's gone. So it does need a fair bit of effort on the licensing.
But what you've touched on there is, if you can protect the brand and can build it, the value of the brand itself then becomes a potential saleable asset at some point in the future. And so you might be running your projects and your brand name in parallel. At some point, you want to shut down your development side of things. What do you do with this entity? It's got all this goodwill in there. Selling it, if you've set it up correctly, is I guess a plausible outcome.
Very much so. And I'm not an accountant or a business valuer, but you'll find that the value of those sorts of assets is really valued quite high. You're moving from, again, with franchising, building something mechanical or building houses, to a financial product, which you grant a license and receive money for not doing so much. And because you're in a financial product market, the financial investors are interested in that. So banks start looking at it, and investors start looking at it, willing to pay a much higher multiple than they would for, say, a property development company, which is a single project vehicle, or may require a lot of capital, may produce limited amounts of income from year to year. Whereas the licensing arrangement can be directed to 5 or 6 different income sources for the year, and properly managed produces what I call premium income, and that can have a substantial value.
Yeah. So you can, I guess, generate the revenue from it. You could equally, if it's yourself to yourself, I'm assuming that you could do this for as little as $1, if that was, I guess, your intent. But I guess creating a revenue stream out of it, even if it is from yourself to yourself, then creates a cash flow that then looks good on, I guess, bank servicing and things like that as well. So there's lots of different ways that you could slice and dice this to actually get it to happen. So there's 2 parts I want to dive a little bit deeper into, if I can, Peter. Firstly, you touched on, I guess, a holding company, and then we touched on, I guess, the actual license itself. So if we talk to the holding company, I guess company or entity, as in a trust. Why one versus the other? Do you think is I guess something to consider?
This will depend on the individual circumstances of the persons involved, but these are general comments. I spoke previously about the benefit of trusts, discretionary trusts and unit trusts. The biggest attraction for those, as far as I'm concerned, is that they get the benefit of the capital gains tax-free status of individuals, and also the benefit of small business exemption for capital gains tax. Now, I've said previously that the development activity, that is building a 10-story apartment building and selling the apartments, is clearly a business, and capital gains tax simply doesn't enter that situation. But remember, we have two separate entities. That is the development company. That is the special purpose vehicle, as Rob refers to it. The holding company over here holds the intellectual property, and it started holding it in 2010. It's still holding it now in 2021. Clearly, it's held it more than 12 months. So it's an asset which could get 50% capital gains tax exemption. And because it's clearly a business asset, because I license it out and get paid, I therefore get small business exemptions. Now, again, there's plenty of articles and reports that Rob's got on capital gains tax. But in short, using a trust and getting the capital gains tax benefits are tremendous because it's almost tax-free. You could almost certainly get it down to 25% tax on the capital gain, and you may be able to get it all tax-free if it's been owned for more than 15 years and various other exemptions. Now, yes, you can do some of that in a company, but it ends up being locked up in the company. Because even though the company gets the small business exemption, it doesn't pay tax on that. But you've got to get the money out of the company, and it can't come out as a franked dividend because the company didn't pay any tax. And when you get it, it's an unfranked dividend, and then you will pay the tax. So you end up paying twice as much tax in a company as you would in a trust, assuming you're eligible for the capital gains tax exemption and the small business exemption and so forth. So given that that's going to be a more permanent feature and a running feature for maybe 5 or 10 or 15 years, it's going to have capital growth. And the concept of capital gains tax are much more important. So the use of a discretionary trust for a sole family group or a unit trust, if there are more than 2 families involved, is very worthwhile considering. In both cases, I recommend a corporate trustee so that you do get the benefit of limited liability. It's a $2 company that acts as trustee, and the real value is in the beneficiaries of the trust, the unit trust or the discretionary beneficiaries.
Yeah. But as per the special purpose vehicle, seek independent advice to make sure which of those is the right one for you, knowing that there are 2 different approaches to actually do that. So whichever entity is the holding entity, I guess it now has some intellectual property, being brand names, being logos, being, I guess, the goodwill and that sort of thing. The actual license agreement itself, what kind of things do we need to consider in that license agreement? You touched on some of them before, but are we talking about something that we write on the back of a napkin, or is this going to be something that goes thud when it hits the desk?
No, it's more likely to go thud when it hits the desk. So we can put as much documentation in it as you wish. So, for example, a comprehensive franchise agreement, which is a license on steroids, is 60 pages long. A simple license agreement is 5 or 6 pages long. They both have the same core elements, but the longer one deals with a whole bunch of ancillary issues, some of which are relevant to us and most of which are not. So we would have a license agreement. It would go into great detail, telling the franchisee, the licensees, what they can and can't do with our business name and our trademark and our logo, when they can use it and what circumstances they can use it. And for example, it might say, you will not publish any advertising in a newspaper or online without our prior approval. So they've got to give it to us first so that they don't talk about, bordellos or things that are very unsavory, and we don't want that connected with our brand name. So we get the right to approve it, and if they don't get the approval, we can stop them instantly from running those ads. So that's the way that we protect our brand name. The license will deal with quality control. It will recite the fact that we own the intellectual property. It will say what is the intellectual property, what part of it can you use, and on what basis. But at the end of the day, the most important thing is it dictates how we get it back, how we can take control of it and stop you from using it in future if you breach the arrangements. So that's very important. It's not that difficult, not that complex, and it's not rocket science. It's not new stuff. We've been doing it for 20, 30 years, business licensing and franchising, and we can use those models quite easily in this type of arrangement.
So the typical ways to call it back in, I'm assuming it would be a fixed time period, for example. It might be, I guess, a specific outcome of the project. It might be the shutting down of the special purpose vehicle so that it no longer exists. And there might be I guess, breaches in, I guess, the terms? Are they advertising when they hadn't sought approval and those sorts of things? Are there any others that I've not covered on, or?
No, I think that pretty much covers it. I mean, there's the breach and the maintenance of quality are the most important ones, and there's also, of course, insolvency issues, financial issues. If they become insolvent, we don't particularly want to have a liquidator brandishing our brand name around, so we'll put provisions in about clawing it back in those circumstances. And it also deals with physically getting these things back. So, we may be talking about printed brochures with our logo on it. We want them all. We may be talking about an operations manual that spells out what sort of bathrooms we put in these places. Well, we want that back. That's subject to copyright. It's ours. We own it. We want all those documents back. We want all the images of our license back. We want all the websites and the links severed, and those sorts of things. So there's a lot that goes into it.
Very good. Mate, anything else that somebody might want to consider in doing, would it be, I guess, planning how and when that you might want to actually start to engage in this process? I guess for me personally, brand name is only worthwhile if what you're going to do is consistent between projects. So if I'm always going to be Rob the budget developer, and I want to be known for, I guess, building the cheapest houses in town, that's a brand. If I want to do some luxury homes and all I ever want to do is luxury homes, that's a brand. But if I'm sometimes the budget builder and sometimes the mansion builder and that sort of thing, what am I actually protecting? Because there's no consistency in what I'm doing. Is there things like that we want to be thinking of above, just why?
Yeah, I guess you want to identify, as I said before, what vehicle you use and how you license it and what you license depends on what people are bringing to the table, what degree of intellectual property they have, what degree of advertising they've expended. I agree with you that the two examples you've given are quite different, and I wouldn't want to have the one brand trying to do those two things. So they would be two separate brands. They could be in the one holding company. They could be in two separate holding companies and licensed to different people doing different styles of buildings, and they'll have different specifications and requirements as to what we expect from the licensees in each case, because they're different. No, licensing is a good way to protect the brand name, and of course, the more projects that are being done with our brand name in it, the more the brand name improves in value, the more it gets better known, the more goodwill attaches to it, and the more valuable it becomes. I just need to touch on the fact that there are rules about having identical business names. So if we've got if we say evoke something, if it's just evoke building, we can license the name evoke, but it will be part of another name, evoke Karina or evoke Malulabar. So that they're separate names. And remember too, that if we're doing a strata title development, the strata title development will have a brand name. It'll have a strata title name. We registered at the strata titles office. So we can't have two with exactly the same name. They've got to have different names that may be by their location, could be by numbers, could be by any number of things, but the brand name is the same. And the other thing about the licensor, he might, and I have done this in joint venture agreements for clients, include obligations on the licensee to actually market our product, to advertise it, to put our name on the signage board that's out the front in various sizes, to put it on the hoardings that go around the outside, to put it on all the contracts and put it on the material and the marketing material, so that our brand name is getting a great deal of publicity. And that's very valuable. And that might result in a discount in the license fee, provided I'm getting all this publicity, and provided it continues to be good publicity and not bad publicity. That's very valuable for the licensor. And that's quite common in joint venture agreements. I do that for clients. And it's that marketing and that branding is incredibly valuable if you can get people to do it for you, particularly for nothing.
What about things like naming of the projects that might live on in perpetuity well past the special purpose vehicle being shut down? So, if I was to build Suncorp Stadium, for example, it's got Suncorp written on it all.
Yeah,
that's a licensing agreement in and of itself. But Suncorp don't own the building. But I guess the developer that did that way back, I guess the person that's actually owning it, they're able to sell those naming rights for that. Can we, I guess, leave things in perpetuity ongoing and still claim an income from that?
Probably not. Ironically, I worked on that Suncorp license agreement. It's a very interesting document, and it's not one that I would burden any of your listeners with. It's about 150 pages long, but not really, not with the development, and that's more from the Body Corporate and Community Management Act. It's not going to allow an ongoing tailing obligation or license fee to be paid to anybody as an encumbrance on the body corporate. However, we're more interested in the project itself, the development project. This Suncorp project is brought to you by, the Smith Developments or something, and Smith Developments is the name we're trying to promote. So it's a name that's going to be going everywhere. And it might not be in the name of the end product. As I mentioned, we'd actually be careful not to have it in the name of the end product, because when we do that, we then get stuck with that name being there forever. We get stuck with them using it for nothing. We get stuck with that project turning into a slum in 20 years' time with our name on it, which is not something we want. So we would focus more on the project development side and bringing the project to completion as a quality project, which the buyers are happy with, the papers are happy with, the authorities are happy with, and everyone's happy with, and it's our goodwill and our branding.
Yeah. There's probably also, just off the top of my head, there's probably 3 different layers to branding for us to consider. So there's personal branding, there's Rob, and who is Rob. There's the company that Rob represents, and then there's the projects that Rob's company might actually be doing. And so there's 3 layers, and you might not want to protect all 3 of those layers through these license agreements, or you may actually want to, depending upon what you're doing. So I guess something to actually be considering in that process. But I guess what we're talking about predominantly today is the development entity and the individual projects that it's actually doing. That's correct.
I mean, you and I know of some project developers around Brisbane that currently have a very good reputation. Again, I won't use names because it'd be inappropriate to do so, but as soon as they put their name on a project, it'll sell out because they're that good and they're that much in demand. And that's what we want to achieve. Mm-hmm.
So Peter, mate, thank you very much for, your input today. Is there any parting words of wisdom that you want to give to anyone who's seeking to start this branding exercise?
Yes. Speak to your advisors, your accountant and your lawyer, and they might refer you on to an intellectual property lawyer to register brand names. It's easier to set these things up at the outset, because once you've got project and it has value, you then have to consider transferring it, which may attract stamp duty and may attract taxes. So if you can do it early in the piece rather than later, that's better. I am mindful of the fact that a lot of my new developer clients come to me and they've got limited cash resources and they don't want to spend several $1,000s setting up a venture, that a separate vehicle. They just need all the money they can get to get this project out of the ground. And I understand that. So maybe keep it in the back of your mind. Get your first project up and running. Once it's running, you can then look at moving this brand name across. And then for the third project, go ahead and use that license. As I mentioned, when you're doing your first project, there is no IP, there is no goodwill. No one's ever heard of it before. It doesn't have a reputation yet. So there's not much value there on the first one. But if you do a good job on the first one, you can then license that name somewhere else. Remembering that the company that you're using, which might be Aardvark Developments or whatever, is going to be wound up. And once it is, that name becomes available at ASIC. And you want to make sure you grab it before someone else does. So you might, while it's still running, get authority to register a very similar company name, put that in your intellectual property holding company, and then when you wind that company up, the name doesn't go to someone else, which is a big risk if you're not taking steps to protect your intellectual property. I just mentioned briefly, business names aren't much of a protection. Company names are a little better, but not much. Trademarks is what you really want. Trademarks are difficult. They have different, you have to register in every different jurisdiction: Australia, US, England, Europe. As a property developer, you don't need to worry about US and Europe, obviously, but for other clients in commercial manufacturing, we do. And there are also different categories within the trademark. So when you register a trademark, you must identify what category of activity you're registering in, and there's a lot of them. And that's where a good trademark attorney can tell you which are the appropriate ones to register, keep the cost at a minimal level, and get you registration. And honestly, a trademark registration is very powerful. And also that's another thing that's under the national laws, it's government laws. Copyright's another one under the national laws, gives you a great deal of protection. And just as an aside, when you hold an asset that's protected by a national law, such as copyright and trademarks, I said before you may have to pay stamp duty, but in fact, with those national laws, there's an argument that you don't have to pay it, because the states can't impose a tax on the federal government. And so this is a federal government authority. And so we're not going to pay the stamp duty on this particular occasion. Thank you very much. But that's fairly advanced stuff, but I'm happy to talk to anyone that's interested in that.
Very good. Well, I guess summarizing all of that last little bit in lay terms, start with the end in mind, have a view of the vision of where you want to be taking your development career, kick off project number one and prove yourself first. The old fake it till you make it, I'm not a very big believer in. So getting your brand name first is probably a little bit excessive, but know what your intention is. Do project number one, do a good job, make sure this is really the career that you want, then come and talk to people like Peter and go, how do we start to lock that in and start to build on that as we grow into the developer that we actually want to be? Yes.
I think, Rob, hopefully they'll be talking to us early in that project phase, because we'll help them with the design of the project, the building unit plan and the CMS and all of that sort of stuff. And you'll be talking to your lawyers and accountants before you turn a sod, a long time before you turn a sod. And you can mention it at that time that ultimately we want to do this. And you may not do it straight away, but it'll be in the back of everybody's mind that that's where we're going to end up. So let's firstly focus on doing a really good project, really good quality, building reputation, and then taking steps to protect it before we finish that first project.
Very good. Thank you, Peter. It's been a pleasure actually hearing from you today. Peter, like many other industry experts that we have, I guess, all the way around the country, we run these events. Not only do we run these Sunday sessions, but we run them as physical events in places like Brisbane, Sydney, Melbourne, and Adelaide. So if you would like to, I guess, see industry experts just like Peter and real deals presented, why not come to one of our meetups anywhere around the country, or they're live streamed if you physically can't get to an event. Peter, thank you very much for your time today. It's been a pleasure. I guess we'll chat to you real soon.
Look forward to it. Thank you.
Okay. Thanks, mate. Bye-bye.
Bye.